Entry would be so we make right balance on hand, it's 3,000, right? It means it must be the case that we have. So in order to justify this 9,000, we need to make entry. We call this adjustment entry. And what is the adjustment entry? Because we consume that and that become our expense. So 9,000 is our expense. Which expense? We segregate that as supplies expense. And we need to decrease this supplies. So we write it down supplies here. Right? So it means we need to open this T account as well. And it says 9,000. So this is debit side, this is credit side. So this is how it basically works in 3-step. Now you understand that, Jordan? Min?
Yes, sir.
Okay. Ajim, can you hear me? Sibade, Junpyo, Chloe, Arone?
Yes.
Yes, sir.
Okay. Let's move forward. And now the depreciation. Depreciation are basically is on the plant assets. So plant assets are long-lived tangible assets such as land, building, furniture, equipment. So it recorded as an asset when purchased, these plant assets, but with exception of the land, because land value with the passage of time increase, not decrease. So except land, the value of the plant asset decline in usefulness. So we call the decline in usefulness as depreciation. So depreciation is a process of allocating cost to expense for a long-term planned asset. For example, if we purchased a car for cash, for $100,000 for 5 years, it means our per year cost of car gonna be 20,000. It means we are allocating the cost, or we are spreading the cost our cost of 100,000 to 5 years. So each year the decrease in usefulness, we charge it with the income statement. Understand? So if you don't understand right now, we have a separate chapter on depreciation, so don't worry about that. I'm just giving you a basic concept right now, but remember that depreciation also has an adjusting entry, because when the year passes, when the accounting period finishes, we must decrease the value of our long-lived assets like trucks, machinery, plant, building, because they decrease in value with the passage of time. So that's why we need an adjusting entry. So to illustrate that, suppose that on June 3, Friday Auto Service purchased equipment on account for 24,000. What is the entry here? Equipment to account payable, because on account, right? And then what happened here? Fred's equipment will remain useful for 5 years and then be worthless. One way to compute the amount of depreciation each year is to divide the cost by 5 years. So this procedure is called straight line depreciation, because we are just dividing this cost straightly on its useful years. Simple. You see here?
So it's 4,800.
Right? So that is yearly. 4,800 is per year. Per month, it's 400. When you divide this 4,800 by 12, that is the monthly depreciation in the equipment. So every time a month passes, we lose its usefulness of about 400. So what is the entry then? Depreciate expense for the June is 400. And what is the purchase value? So from 24,000, we consume this asset 400. It means we need to make an entry. So it means the usage, we use that one, it becomes expense. So especially this expense name is called depreciation. But remember, when we make depreciation, we charge it for the whole year, right? For the whole year. So it means we create the entry and we create the opposite account for depreciation. We call this depreciation to accumulated depreciation. That is a little bit weird, right? How? Because we create a contra account, means a negative of the account. So equipment, let me just give you the treatment, how we treat our assets. So normally when assets are purchased, they are recorded on cost. For example, 24,000, so that it shows us the true value of so if we decrease this asset on yearly basis, for example 4,800 here, so it will be like 23,200 23,200, because yearly depreciation is 4,800. So if we decrease our value of the equipment from 24,000 to 23,200, then if somebody wants to know that how much or what we paid originally for this asset, if someone wants to know after 3 years how much we paid for the for this asset, then he need to open 3 years data. He need to go through and in a company, it's not just one asset, it's thousands of assets. We have 10,000 chairs, and then we have 200 or 2,000, office tables. Then we have 1,000 ACs, and then we have 300 cars, 2,000 trucks, right? So better way is that a better method is you create contra account, which is the opposite. We call this accumulated depreciation. So that our equipment value remains 24,000, and what we have to do, we need to increase the accumulated depreciation on year by year unless it becomes 24,000 in 5 years and our balance is 0. So even during the year, at year 3, if somebody wants to know how much is the value of our asset, how much we purchased for the asset, you still know that the original cost is 24,000, and accumulated depreciation after the 3 years, because 4,800 is yearly, so it is 14,400. So if we do not create this accumulated account, then the balance sheet will tell us that we have equipment worth of 9,600 after or on year 3, right? So in that case, because company has a lot of assets, so that's why we create accumulated depreciation account, which is the opposite of equipment, which means the accumulated depreciation start increasing, and because this is a negative number, and when 5 years gone, the amount equals to the equipment account and the balance would be 0. So it's time to replace this equipment. This is what we mean by here to creating the accumulated depreciation. So I hope I clarify you. If you even can retain 60 to 70% of what we discuss here, you are in good shape, because we have a separate chapter to deal with this depreciation stuff. So here we go. So if expense occurred, we charge that